Good morning, everyone. I'm Brett Tejpaul, the co-CEO of Coinbase Institutional, and I'm here from Davos. It's the first morning at Davos, and I'm here with Faryar, who's our Chief Policy Officer. And we're going to do some framing and have a discussion on what's to come in Davos. So here's the framing. We're coming in hot off a really successful week in Abu Dhabi. For the institutional business, we launched some really key partnerships. We had bank partnerships with PNC. We announced a series of transactions and integrations with JP Morgan. We did the same with Standard Chartered. So there's a ton of institutional adoption that's going on. The crypto world is in anxious anticipation of the market structure bill, where we're all set up, we were ready, we were going into it, and then our founder and CEO, Brian Armstrong, withdrew his support for that bill. And everyone wants to know why. So we're going to open up a conversation and give some context around that, and then we're going to talk about our exciting week in Davos. Faryar, help us understand what happened. I mean, the crypto world is so excited. We've got the stablecoin bill that has been a massive catalyst to really driving institutional adoption. We feel like maybe we were just on the 1 yard line at getting this next big giant step, and Coinbase withdrew its support. Why did we do that?
Well, legislation is really important. I think we saw over the course of the last 4 years under the previous administration that when you have uncertainty in the regulations, it can become a huge drag on the development of the industry. The Genius Act, which is the stablecoin bill that you were talking about, was not a perfect bill, but it was a very good bill. And even in the 5 months since adoption, there have been something like 200 separate commercial announcements with companies integrating stablecoins into their systems and payments and their infrastructure. And so we looked at the market structure bill through that same lens. It didn't need to be perfect, but it had to be good enough to be a catalyst for adoption and development. And we weren't able to see the actual text until 48 hours before the markup, which is when the committee was going to decide whether they were going to endorse it. And we fundamentally made a decision that within it were some real deep problems that had to be addressed. Our industry partners actually didn't disagree with us on the substance of our concerns, but some people felt like the committee should proceed and then it'll get fixed later. Our own experience and my experience, having done this sort of stuff for a long time, is that it's very hard to unwind bad legislation. And so in the spirit of trying to get it right, understanding that compromise is necessary, Brian spoke up. And now everyone's back at the table. So I feel pretty good about where we are.
Well, I think we need to actually, for this crowd in particular, double click a little bit because we really don't want people to think that we're looking for perfection.
No.
And in fact, there were some really, really substantive things that were introduced, from our perspective, a little late in the lawmaking process, but they're actually really big impediments to Coinbase. And I think it hits us a little harder, given that we have this breadth of platform across both retail and institutional. And I'm not sure in the moment that people fully appreciated just how big the blockers were.
Yeah.
So it wasn't a series of small things which in aggregate could be big. There are actually some really big things like the SEC exemptive authority point. So let's talk about that.
Yeah. So there are about 6 things that cause us enormous concern. These are not sort of areas of compromise where you win some, you lose some. These were big fundamental things. And one was the SEC exemptive authority. Now there's some dispute on the part of the staff about what they intended to put into the bill, but the language said what it did. And basically it said that with regard to digital assets and tokenization, the SEC by law would be prohibited from providing exemptive relief. And I think the clients know, and I think folks who are in the sector understand that the way the SEC has always accommodated technology over the last 50 years or 90 years has been through the use of exemptive relief. And so for the first time, there was going to be a bill that Congress was going to ratify through a committee that would statutorily take the exemptive relief authority away from the SEC. Given how much Chairman Atkins is talking about actually issuing an innovation exemption to allow for the tokenization of capital market activity, and most people expect that would be coming out in a matter of weeks, we thought it would be an enormous strategic mistake to have a Republican-led committee of jurisdiction in the Senate pass a law or pass out of committee an act that would take away exemptive relief authority from the SEC right at the 0 hour, right before the SEC is about to provide exemptive relief for tokenization. And I think that would have been an enormously difficult thing to unwind, and so we felt like we had to raise the concern. And then the second thing had to do with the banks were trying
Sorry,
to
can we just pause there for 1 second, because don't mean to interrupt.
Yeah.
I just want to explain to everyone who's less familiar with all these terms of what that means. So we have Chairman Atkins, who's amazing.
Yeah.
And he wants to see, and the SEC wants to see innovation take place at an accelerated rate. And so one of the ways that this exemptive relief is giving us is as we think about which assets will be tokenized, we're not really at a point where there's black and white determination of what is or what isn't a security.
Yeah.
And so as we work through that as an industry and we go through a whole number of different things that come to market, one of the things that's super helpful is to have this exemption that sits on top that allows innovation to actually continue and progress towards markets. And if we get to a point where something could be interpreted as a security, that gives the industry the ability to actually bring things to market.
That's right.
And so the withdrawal of that is a real impediment. And so that would, in effect, remove the ability to really move forward at pace and bring things to market.
No, exactly. I think that's well said. I would say even framing out a little bigger, people wonder what the difference is between the U.S. capital markets from a regulatory perspective and European capital markets from a regulatory perspective, so EU and UK. And if I had to pick one thing that was the distinguishing factor, the advantage that the United States has is the ability of the regulators to provide exemptive relief. So European regulators also look at opportunities where innovators will come to them and say, we want to adopt this innovation into the market. Can we get permission to do that on a trial basis to see how it develops? In Europe, they typically do what's called a sandbox, and sandboxes are time limited and scale limited. In the US, what the US has always had is exemptive relief, which allows an innovator to invest heavily into an innovation subject to the SEC's approval through an exemptive relief grant. And then that becomes eventually something that the SEC can do notice and comment rulemaking, so pass a formal rule. So all of this sounds quite technical, but it's an enormous strategic advantage that the United States has, and to have Congress take that authority away from the SEC would be a catastrophe.
Great explanation. Let's roll on to the next big one.
Yeah. So the next thing is on stablecoins. So the Genius Act passed 4 months ago. The banks, a coalition of banks stood up and they said, well, we don't like what happened in the Genius Act. In particular, they were concerned about the compromise that was struck with the banks that would prohibit issuers of stablecoins from paying interest or yield, but allowed exchanges or third-party distributors to provide rewards. Now, rewards and interest provided by the issuer are very different things. Rewards are paid out of the balance sheet. There's no commitment of ongoing return. So all of this is carefully cabined in. The banks came in and said, okay, well, we will use our political power in Washington to block market structure legislation unless you agree to unwind the Genius Act that was passed 4 months ago. Now, this is, by Washington standards, just to put it kind of mildly, a highly unusual thing to do, to have Congress on a significant bipartisan basis pass one of the president's signature achievements and have an industry show up 3 months later and say, you know what, let's unwind a significant pillar of that. And so that was the second thing we held the line on. And
so I want to pause there and actually double click on it because it's worth it. So some framing for me on this is we talked about the Genius Act was the major thing that allowed the major piece of legislature that allowed stablecoins to enter the mainstream system of the U.S. And it was really that moment which served as the biggest catalyst, which I just talked about at the beginning, of having all the banks actually adopt this and want to push forward. And so, as you mentioned, we have over 300 mandates for our crypto as a service.
Yeah.
And what that means is financial institutions of all kinds, the TradFi world, the bank world, they're actually, they may have a complicated position at the moment because they may be protecting maybe a part of their business, but at the same time, they're leaning into it. and they're using Coinbase as the main platform by which they're activating. And so one of the things is, as a student of markets for my entire career, I'm a big advocate of letting the capital markets decide. So there's not one stablecoin, there are many. And the US is a place where there should be open competition. And while I understand that vested interests of banking may want to be a bit protective of deposits or that sort of thing, we certainly don't want to have a backdrop of an American market that's anti-competitive or is ring-fencing things and not allowing actually innovation to proceed. And so I think if you see this sort of attempt to like renegotiate what had already been passed, it puts a little bit of a dark light on and gives you a little bit more perspective on why we thought it was so important actually to keep what we've already agreed and then set the stage for further innovation and then really allow banks and crypto firms and emerging stablecoin providers and everyone that wants to compete in the space to design the next best stablecoin, or in fact, we probably hope that people continue to actually use those stablecoins, which have already gained traction, and we're able to actually offer them across the platform, across borders, et cetera. So this is a really, really big point.
Yeah, and I think your broader point is also probably worth restating. Coinbase is probably the biggest infrastructure provider to banks who are looking to get into tokenization and stablecoins. In fact, here at Davos, Brian Armstrong has meetings with, I think, 4 bank CEOs, 4 of the largest bank CEOs in the world, to discuss, the ongoing partnership we have with them. There are a lot of issues. My own experience, having been in Washington for a long time, is that you can have these sort of funny dynamics where you have the lobbyists and the trade associations and the DC folks get into a fight over something. Because they're just sort of accustomed to drawing lines where they've drawn lines. And it often requires the CEOs to come in and just sort of tell everyone to cool it and understand the broader picture. And so part of what we're trying to do with this is on the market structure bill with regard to where the banks are is obviously work the Washington process, but also to bring the CEOs in and say, this is an opportunity for banks as much as it is for any other sector of the economy. And I think we'll get there.
Me too.
Yeah.
What are the other substantive points that came up? I mean, we may be going into slightly smaller ones, but again, in aggregate, I want to tease out a few more which we thought were substantive blockers.
Yeah, maybe I'll do one more. So in the U.S., there's a very funny dynamic. We're the only country in the world that has 2 different market regulators. The 2 regulators, the SEC and the CFTC, are regulated or overseen by 2 different committees in Congress. So the Banking Committee in the Senate for the SEC and the Agriculture Committee in the Senate for the CFTC. And so when we pass legislation that involves comprehensive market structure issues, like our crypto market structure bill does, it has to go through 2 different committees on 2 different bills that are taken up at 2 different times. And so reconciling the 2 becomes a really complicated exercise just as a matter of legislative process. And what you have with the Banking Committee proceeding is they were in a position where they were essentially saying that token issuers that were issuing a non-security token, in other words, something that would be regulated by the CFTC, would first have to go to the SEC, get the SEC's approval before going to the CFTC. In normal sort of Washington world, the other committee of jurisdiction would speak up and say, one agency cannot be the front door to the second agency. We're co-equal agencies. For reasons we don't fully have our arms around, that didn't settle out in the normal process, but it was a terrible precedent to have access to an agency that has been in place for decades be conditioned on going to a second agency on a matter not related to their jurisdiction. And so we needed to clarify that. These things sound somewhat technical, but I think our clients understand, operating in highly regulated markets, how important it is to get big fundamental principles of regulation right. And I think we'll get there. So I'm actually quite optimistic, although there was a little bit of drama last week in Washington over the legislation. It's a process in the United States to go through a bit of a roller coaster before new law gets enacted.
I just want to reflect a little bit about that point because as it happens, I started my career in the U.S. and I've always been operating there and had a chance to live abroad for 12 years. So I've worked under the European framework, the U.S. framework. And so running global businesses in a follow the sun world, I work with the patchwork quilt of regulators at all times. And to be fair, there's never perfect clarity across any one place, let alone the global landscape. So I'm kind of used to a little bit of this, teamwork, let's say, to get things done. So I don't think anyone's waiting for perfect clarity, as it were. I do want to restate, though, because Coinbase has had an interesting relationship with the SEC over time, and now we're really super aligned. And we're aligned with the CFTC, and I think there's a coalition of the willing across Democrats and Republicans. I think the big picture trend is that we want to get another big step of clarity from U.S. markets. So my question to you is, where do we go from here? So in this moment of temporary withdrawal of support, to sort of have a timeout, right? A timeout, reality check. Is this really where we want to go? Help me understand what happens from here.
Well, as you said at the outset, the goal is regulatory clarity. And we're very lucky in the United States that we essentially have two paths in front of us. The one path that we've been working very hard on, but is unquestionably the harder path, is to get legislation passed that addresses some of these key principles that need to be resolved with regard to tokenized markets, digital asset markets. And we're very committed to doing that from a kind of a Washington systemic approach. There's a value in having Congress speak to an issue and the president sign into law a new regulatory framework for a sector. But we do have a second path, which is to work directly with the agencies. Now that is more, it doesn't have the permanence of legislation, but we have an SEC and a CFTC and a Trump administration that's very committed to providing clarity through regulatory authorities that the agencies have. And so we see those things as very complementary. We're very committed to the legislative path, but there's a complementary regulatory path, and we're working both of those. The reason I'm sort of going through all of that is there's no question we will find ourselves incrementally by the month, but certainly a year from now, 2 years from now, with dramatically clarified rules around how the digital asset markets operate. So I'm very optimistic about where we're going in the broader goal of regulatory clarity. There's a couple of different paths, very complementary, in front of us, and we're going to take advantage of both of them. And I feel very optimistic about our clients, ourselves, everybody who wants to just kind of understand what the rules of the road are, all of that becoming much clearer even 6 months from now.
Now, I wanted to end on two big picture points. The first one is, if I try to channel the thoughts going through a bank CEO in this moment, going back to where we started at the beginning, you've seen this technology be adopted. It's in the mainstream, as we said. And as bank CEOs and asset managers and some of the leaders that I don't need to name now have hypothesized about where this is headed, you see a big picture vision. The big picture vision first begins with brokerage. So the ability to brokerage financing, all the things that anyone does with let's say, a crypto asset. And banks want to be enabled to actually meet their client demands. So that's a big bucket. The second thing is really stablecoins and payments. And again, actually, it's another use of the same platform. And so we're seeing banks, financial institutions everywhere that already have huge and very, very active payments businesses now using stablecoins to facilitate quick and fast transfers. And the third bucket is tokenization. And tokenization is really the beginning of taking financial assets, which today exist outside the crypto ecosystem, and bringing them into the crypto, onto crypto rails. And so I'm super encouraged by the adoption, if you like, of the banks. And so that's what I think is, notwithstanding maybe a little bit of negotiation, as it were, on where the ring fencing is and whether interest or not interest. So that's a big picture point, number one. Big picture point number two is that our position, Coinbase at large, our position is one where we have the biggest breadth of platform. And so we have the whole retail landscape globally and institutions globally. And so when our clients are speaking to other competitors or other people that are active in the crypto ecosystem, a lot of them are what you would call single issue voters. So maybe it's a competing stablecoin, but they're individually vested in a singular issue.
Yeah.
And when I was at the CFC event and news of Coinbase having withdrawn its support for the bill, there was a lot of booing in the room. I was with the whole crypto community. And as the night unfolded and people asked me more about why we were taking this position, I think it became clear to our friends in the crypto ecosystem that we were doing the right thing for the business by actually tapping the brakes, taking a time out and saying, listen, we have to solve for the whole here, not just individual issues. So I'm personally super excited about where we head from here. I'm grateful of all the time that you've invested, and you got to make it happen.
I will. I'm very excited. Can I add one more layer to your framing? I think when the internet came about, the big innovation, and when people began to understand the value of the internet, they understood it as an efficiency play. I used to have to send paper correspondence. I could now send an email. That was a big, gigantic step change in how we were able to engage with each other on data. And the internet became really exciting. Looking back, it's all kind of quaint now because you have programmability with data on the internet. And so we have video, we have any number of applications, including the development of artificial intelligence, which is enabled by the technology of the internet. We're sort of at that very first stage of blockchain digital asset technology, where we talk about it heavily as a efficiency play. Payments use, ACH or wires take 3 days, cost X amounts. Stablecoin payments can be settled in a second. Capital markets activities have atomistic settlement. And so we talk about it very much in efficiency perspectives. The reason why we take such a careful perspective, understanding compromise is ultimately where you need to go, and why Coinbase as a company invests in things like Base and Layer 2 protocols and is so protective of the activities of developers, is that we're only at the very beginning of programmability. So we are seeing the benefits of digital assets from an efficiency perspective, but we're just at the beginning stages of seeing programmability where you can build any number of applications that automate existing applications, not just for efficiency, but to manifest in different use cases. And I think that's really, really exciting and important to keep in mind. And we try to put into the debate in Washington. But the bottom line is we're going to get legislation done. I feel very good about it. Democrats, Republicans, the administration, everyone's back at the table. Everybody understands the issues that we raised are the kinds of things that need to get addressed. We're working with the banks, my counterparts there, to figure out something that's a win-win for them. So we'll get there. And it's the right thing to do.
All right, well, we have a super exciting week to come. I look forward to giving you another update sometime later in the week. Bye for now.